Proper identification of fair value gap is important if you want to really trade smart money concepts the right way and know the fair value gap that is mitigated and the one that is not mitigated. So in this video, let's discuss proper identification of fair value gap on your price action and know which fair value gap is mitigated and which one is not mitigated, and which fair value gap is important for you to consider, and many more. All of this in this very video. Pay attention and watch this video all the way to the very end. The first thing we have to discuss here is, what is a fair value gap? When do we see a fair value gap occur in the market? A fair value gap, FVG, in trading refers to a region or a price zone where there is an imbalance between buy and selling pressure. And this is very important. If you consider this very price action right here, Euro USD, and you are being told to identify fair value gap, it's very simple. You identify fair value gap from a region that is a resistance or support level. So in this very case, if we are to identify fair value gap from here all the way to the downside, where are the fair value gaps in this very market from here moving downward? So the first thing here is, if you look at it, market moved down, and we want to see where there was an imbalance in the market. And the first point we see an imbalance here is this very movement downward, because market moved down and then move up again, move down. So we can call here a point of imbalance between this very week and this very third candle week right here. So this is a point of imbalance that we see right here on the market moving downward. And the next point of imbalance as well is between this candle wick and this other candle wick right here. So we have another fair value gap right at this very point. Okay, so we have a fair value gap right here. The first thing is identification. So we have a fair value gap right at this very point. And if you look at the market moving downward, we have another fair value gap right at this very point as well. Just follow me gradually. We have a fair value gap right here. And if you look here, there was no fair value gap right here. If you come down a little bit, we have a fair value gap from here moving downward. So we have a fair value gap from this very point to this very area. There is a fair value gap right at this very point. And if you look downward, there was no fair value gap from this resistance down, because this very weak right here and this very weak come close to each other. Okay, if you look at this very area, there is a little fair value gap as well from this very point to this very area. So we can draw this out. The first thing is identification. So we have a little fair value gap right at this very point. And if you look here from this very area to this very point, discover that there was no fair value gap market moving from here upward. Okay, very important. And from this very point, there is a fair value gap from there to this very area. So we have another fair value gap right at this very point. And the next fair value gap we have right here, where the market have not touched, is at this very point. We have a fair value gap between this very point and this very area. We have a very huge fair value gap here, and another fair value gap right at this very point. So the first thing is identification of this fair value gap. Why is it important? It is important because at this fair value gaps level, markets have to visit that level to create a balance. Remember, a fair value gap is a point or price zone or a region where there is an imbalance between buying and selling pressure. So if there is an imbalance in the market have to come back to that very point most at time to balance out the market. So if an imbalance is created right at this very point, market have to come back to balance it. And if an imbalance is created right here, market have to come back to balance it. So when there is a balance is where we call mitigation. Let's look at point of mitigation on these fair value gaps that we've drawn on this price action. The first one is this very fair value gap right here have not been mitigated at all. But if you look at this very point, this very fair value gap right here, was mitigated at this very area, which is very clear. With this very candle, it was mitigated. This one mitigated as well. We have a mitigation right here and mitigation right at this very point. If you go down a little bit with this very fair value gap that occur here, you discover that we have a mitigation right at this very point and at this very area. So this market have been mitigated and this fair value gap is now invalid. Now, once a fair value gap is mitigated, then that fair value gap is now inactive. Don't consider that fair value gap to be important anymore. And the next one we see right here is this very point. So this very area mitigate this fair value gap, this one mitigate it, and this other one mitigate it as well. And the next one is this very point. We see mitigation with this very candle. And if you look at this very one, these ones have not been mitigated. So you can tell which fair value gap has been mitigated with what has happened already in the past with these other fair value gaps, and the one that have not been mitigated with this one right here. So we can have the market come back down to this very area to mitigate this very fair value gap. Either the market come into this very zone with a wick and move upward, or it come back into here and close inside of the fair value gap before market is going to move upward, or the market can go right down, break through this very fair value gap and come into this very fair value gap before moving upward. This is very important, and the reason why market comes into fair value gap like this is to balance out the markets, because if an imbalance is created between this very point and this very area, market have to come back down for there to be a balance between buy and sell pressure. And when a balance occur, an imbalance will be created for the market to move upward again. Now, if you understand the market in this perspective, it will be very easy for you to trade fair value gaps. So the first thing is identification of fair value gap and which one is mitigated and which one is not mitigated. So that is very, very important, as you can see on the price action right here. The next thing here is how to properly draw fair value gap. Now, if you notice, market move from here with this very bullish candle, bearish candle, come back down. One important thing here about fair value gap proper identification is if you consider this very point, which is a bullish candle, then we have a bearish candle and then a bullish candle. There is a gap right here between the wick of this very candle and the wick of this very bullish candle right here. So we have a gap right here. Now, the issue with this very fair value gap is that it formed a bullish candle, bearish candle, and then a bullish candle. Now, when you want to consider a fair value gap that is important, we want to see a bullish candle straight all the way upward. Okay, it should be a bullish candle upward. If the market is going bullish, we want to see a bullish candle straight moving upward to give us a very clear fair value gap in this very case. So two straight bullish candle will form your perfect fair value gap. In this very case, we can say from the wick of this very candle, okay, so the wick of this very candle should form our fair value gap, which is very important. And that is exact same thing we see right at this very point. We have three straight bearish candle coming downward, and this should form our fair value gap. The gap between the wick of this first one and the third one should form our fair value gap. And if you look at this one as well, the market continue and we have another gap right here. Look at this very one, three straight bearish candle all the way to the downside, and our fair value gap is between the wick of the first one and this other one right here. So that is how you draw your fair value gap, to be very exact. And for a bullish formation, look at it right here. Market move with this bullish candle, move with this bullish candle, move with this bullish candle. So your fair value gap is the wick of this very first bullish candle and the last bullish candle, which is the third bullish candle. This form your fair value gap, and the gap between this very bearish candle and this other bullish candle is also a fair value gap. Now, one concept that is also very important is if you have a gap in this very case, let's say for example you have a bearish candle right here, and you have a bullish candle. That is, you have bearish bullish candle in this very case right at this very point on the chart. Okay, that means this also can create a fair value gap, which you should also take into consideration. It will not be as powerful as when you see straight 3 bearish candle or straight 3 bullish candle forming fair value gaps, and that is also very important, so you can consider this. Another example of this very category is that if you look at usdjpy, market moved down with this very candle, and between this very bullish candle and this bearish candle there is a gap, and that forms a fair value gap. Okay, so from this very weak of this bullish candle to the weak of this very bearish candle forms a gap right here, and market come back into the area and mitigate that very fair value gap, and this is very important. Okay, this is also a fair value gap that has been mitigated. Market come back down, and we see right here another fair value gap on this very trading pair from here, okay, to this very point, have a fair value gap right here, which market come into this very fair value gap, and the fair value gap got mitigated with this bullish candle right here. Market come back down, and if you go down a little bit, we have another fair value gap between this very bearish candle and this other bearish candle. There is a gap between it, and at that very point as well, there is a fair value gap as well, which is right here. Market come into it at this very point, and the fair value gap is mitigated. Market come back down. So this is how you identify and properly draw your fair value gap. Like I said earlier, the most powerful fair value gap you should consider trading on your price action is where you see 3 bearish candle coming from resistance, like in this very case, all the way to the downside. And another one is this very case on this very euro USD price action, where you see bullish candle all the way to the upside. This is another powerful fair value gap that you should pay attention to. Other fair value gap on price action are also important, but they are not as important as this very one. For example, we see a bullish candle here, a bearish candle. This is also a fair value gap, but it's not as important as when you will see 3 bearish candle consecutively or 3 bullish candle consecutively all the way to the upside. So that is how you can properly identify fair value gap properly and know the one that has been mitigated and the one that have not been mitigated on your price action. I hope you enjoyed this very video. Consider supporting this channel by leaving a like for this video. Subscribe right now if you have not, and turn on the bell notification for more forex videos like this one. Also check the channel for other forex content. Join our Telegram channel for more forex videos, day trade and investing strategies, and technical analysis. The link in the description of this very video and also in the pinned comment. It is a free channel. Join right now. And if you want to watch my other videos, check right here and check this video out as well. It's going to help you. Thanks for your support.